If you saw the reaction on Friday in the bond markets, the issue of term premia and credit risk that you have spoken about for very long, that doesn't look like it's going away anytime soon. So, well, really, interest rates will actually perhaps go up, or at least not come down for a large number of corporates.
I know. No, you're absolutely right. I think so if you see the OIS market, it's effectively already pricing in a 50 basis point cut from what I last saw, so 4.9%. So on that, a 6.8% bond yield means a 190 basis point term premium, which is astounding in an environment where the RBI is actually buying 2-3 lakh crores of bonds, and the government has yet not talked about a fiscal slippage. So, and after this stimulus, given that we all know what is, well, we can guess on how this will be funded and so on and so forth, and how medium-term positive it is for ratings. For weird reasons, the bond market decides to sell off. My sense is, and there are disagreements on this, that this term premium is less about the fiscal slippage and the crowding out, because the India's the economy or the capital account is closed to a large extent, but it's not that we just sort of dipping into the domestic savings. There's a lot of capital that can come in from outside as well. So it's wrong to think about crowding out and the PSBR, the public sector borrowing requirements, etc. My sense is that it is a signaling problem, as we've often discussed on your show, that the MPC has erred in saying, okay, we're cutting by 25, but this is it. We're cutting by 25, but this is it. Given that 45% of the bond market is of the bond ownership is with PSU banks, with the Treasury departments, sad to say, is not really driven by profit motive, and it's actually quite lethargic. I would say that, and this is not to criticize the market. The market is the market. We need to learn how to navigate through it, and also, if you're a policymaker, guide it. And my sense is that as the guidance improves, in the sense that, okay, so let me take a step back, and a framework which I have used and which perhaps is useful revisiting, is worth revisiting, is interest rates that a borrower sees consists of 4 parts. The first is inflation. Second is real repo rate. So this is the repo rate, the short-term risk-free rate. Third part is the term premium. So repo rate plus term premium is the 10-year bond yield, right? So this is the third part. Add to that the credit spread. This is a bond market equivalent. You can create a parallel one for the banks as well. Now, inflation has come down, and this is something that I have long believed is the crux of the problem, that our inflation is half of what it was averaging over the past 6 decades. The last 4 years is the 3.8, the last 60 years was 7.5, and neither the government nor the corporates have adjusted to it. So the corporates thought that inflation would take away their debt burden, or rather reduce their debt burden, and it's not doing so. The government thought that nominal GDP growth will remain at 12%. It's not going to be that. And therefore the tax assumptions, the compensation that states need to pay, all that needs to be adjusted downward. So interest rates need to fall. What has happened is that while inflation has come down, the real repo rate is averaging 2.5% over the last 5 years. It's even now 2.2%. Even if you build in the 50 basis points of cut with everyone expects in the coming monetary policy meeting, it's still 1.7%. I think there's another maybe 80 basis point after this 50 basis point cut. So there is a significant reduction that can happen even in the repo rate. The term premium, you're right. I mean, it is worth questioning that with 20 basis point potential slippage in the central deficit, do you really want to be talking about a 190 basis point term premium? And I think it's a matter of signaling. It will come down, and then there's also you must have noticed that a new bond index is going to come up, and that's actually trading at 6.2. But we need to see it in the context of signaling of where interest rates are headed, and if they're appropriately done, I think the 10-year bond yields will come down. And the last segment is the credit spread, which is about the capacity of the banking system and the intentions of the banking system to lend. So what has happened in the last 3-4 months is that the credit spreads have widened as well. So what I'm told is that in the auto market, if 3-4% of the potential borrowers who are being rejected. So so you go and buy a car and you apply for a car loan. The loan is available, but earlier 3-4% of the applicants were rejected. Now 20% of the applicants have been rejected in some markets. So banks have tightened. So basically the credit score at which this it shows the credit spreads have actually widened, and the same has happened for banks lending to corporates as well. And so this is a financial system capacity problem, which will take some time to adjust. But I think the repo rate and the term premium, I think, can still fall, and they need to fall for us to be able to see lower rates. I think this whole issue about PSBR has been, I think, blown out of proportion, given the quantum of, if it was pure demand supply, and we discussed this on your show the last time I was there, given the quantum of OMOs purchases that the RBI is doing, it's not about demand supply. I think it's about anchoring, it's about medium-term outlook, a medium-term fiscal outlook, the resolve of the government to stick to its fiscal consolidation path, and all of those, in my view, are indicating that the term premium should be much lower.